moving on to New Zealand, the New Zealand dollar versus the Canadian dollar, we've got something quite interesting as well. On the weekly time frame, we have a bullish pin bar reversal at a horizontal level here, just below 0.8800, and the low of this week is at a lower point than the preceding few weeks. What is interesting as well is the fact that we've got a 1.618 Fibonacci extension, and this is an ABCD pattern here. I know it's quite steep in terms of, let me just draw it for you so you've got an idea really how we're coming to these ABCD patterns. So A, B, C, D. Sometimes AB doesn't equal CD. Sometimes we've got an extension. So what we do is we take the Fibonacci from B to A, and it will give us either the 1.272 or 1.618. Both are very valid potential buys, but the interesting point about the 1.618 here is it correlates with this horizontal level here, like so. And I know we've got quite a steep downtrend coming into this for the preceding, say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, let's say 15 weeks. But we are weighing up the evidence, okay? And this is at the bottom of a soft, reasonably well-established range. If we look at the monthly, we are in a general upward trend. Okay, now we're kind of like topping out at the moment, but that's the question, and this is where it's a real test. Okay, we might be topping out, this might be range bound now, and we might be at the top of a long-term range, but if we do not take this trade based on that, and it does go all the way up to this point again, then we'll be kicking ourselves. So it's good to ask yourself, what is the worst possible thing that can happen if I take this trade versus what is the worst possible thing that can happen if I don't take this trade? Suffice to say, if you don't take the trade, you'll miss out on very good profit potential, potentially, given that our entry is at the high of this week, stop loss below the low of this week, and potential target, the midpoint, ultimate target, this multi-year high here. There we go. And of course, if we don't take the trade, yeah, sure, we've got no upside through not being in the trade, but we've also got no risk as well. So the worst possible thing that can happen if you do take the trade is it goes wrong and it completely bombs and we lose 2 or 1%, or however much you risk. Okay, so we've got some more evidence in favor of this trade as well. I just want to show you on the 4 hourly. This is what we call time frame correlation, when we've got, okay, we've got the level, the Fibonacci extension, and now what's interesting is we've got this. We've got the left hand shoulder, the head, the right hand shoulder, and we've got the neckline around about here. There we go. So whilst we can see on the 4 hourly we've got lower highs and lower lows, here we are. What is interesting now is that's come to a bit of an end. We've got this head, left hand shoulder, right hand shoulder. Of course, the shoulders don't have to be symmetrical necessarily. It's a little bit skew-if, but that's fine. So a good way to enter this one would simply be the conservative entry, given that we would only be triggered into the trade if we have our entry above the high of this week, entry around about here, stop loss below the low of this week, would only essentially be triggered into the trade if we did get the break of the neckline on the 4 hourly time frame. Okay, the good thing as well with this is if we're going long on the New Zealand dollar and essentially send the Canadian dollar, then we have positive carry as well, given that the interest rates in New Zealand are 1.75%, whereas in Canada I believe they're just 1%.